Consecutive days and two divergent views coming in on Avenue Supermarts, a bullish case coming in from CLSA and a bearish case on the other side from Goldman Sachs today. So let's understand what the bull and bear case is made by and put forth by both of these brokerages. To start by, let's talk about the stance and the target price set out by both of these brokerages. And on the bullish side, CLSA has reiterated its high conviction outperform rating on DMart with a target price of 6,300 rupees per share, which is roughly a 64% upside to the current market price. On the flip side, Goldman Sachs continues to be bearish. They've maintained their sell rating with a target price unchanged at 3,425 rupees, roughly a 12% cut from where the current market price is. Let's talk about valuations now. CLSA believes that once the free cash flow, that will start looking good and it will start looking attractive post the correction and post the stabilization that it has in its store expansion plans, and risk reward favors an outperform rating from them. On the flip side, on the bearish case, earnings downgrade cycle continues while valuations continue to be elevated, is what Goldman Sachs is flagging off for DMart, and they are saying that despite the recent correction, the stock still is trading with a very high valuation at 75 times the FY27 estimate. So that's the bull and bear case on valuations. Let's now look at the earnings outlook that both these brokerages have for this company. On the bullish front, CLSA believes that DMart is expanding its private label offering, and this is happening at a discount of 40 to 50% versus other branded alternatives. They're scaling their private labels to support long-term margin and cash flow improvement, and India's consumption and retail outlook remains robust. On the flip side, let's talk about the bear case that Goldman Sachs is presenting here. They believe that the company faces heightened execution as well as estimates risk, and FY26 consensus EPS is already down 9.6% on a year-to-date basis. Now, if they want to meet the FY26 consensus, this is what Goldman Sachs believes, that the second half PAT must grow at 25% versus just the 2% growth we've seen on a year-on-year basis in the first half. This seems like an unlikely event, and this is why Goldman Sachs believes that there could be further room for more downgrades on the stock going ahead. Shifting focus to the store addition metric. On the bull front, CLSA believes store additions will remain high in the next few years. They see store addition rate at 15 to 20% annually, and in fact, management currently has the visibility for 2,200 stores. On the flip side, Goldman Sachs is forecasting only 75 store additions in all of FY26 compared to 50 in FY25. The market right now is anticipating 85 to 90 is what Goldman Sachs believes based on their conversation with analysts, and this elevates the risk of missing the store addition targets that the company had set for itself at the start of the year. Lastly, let's talk about how DMart stacks up versus competition from its quick commerce peers. On this front, CLSA believes that value retailers like DMart will continue to stay relevant for India's mass urban consumers. Quick commerce is projected to grow less than 20% of FY35 urban consumption according to CLSA, and this leaves a large addressable pool for DMart, and DMart's business model has deep competitive moats against quick commerce is what they believe. And on the flip side, Goldman Sachs believes that competitive intensity for DMart is rising and is quite high because of the rising demand for quick commerce and new players in this segment, and Blinkit's net order value is expected to exceed Avenue's net sales by FY27. That's a big negative for DMart that Goldman Sachs is projecting based on their predictions. So that's the bull versus bear case coming in on Avenue Supermarts or DMarts as we know it. Two brokerages, two very opposite views in two consecutive trading sessions. So that's what stood out to us.